Tobias, thank you so much for joining us. In terms of what we're seeing, it's creeping higher and higher, and yet actually Libya doesn't have that much oil producing. It just have a higher quality than some of their neighbors. What kind of price forecast can you give us?
Well, we think the oil price at current levels is fundamentally a bit too high, given where spare capacities are and where inventories are. There is, in our view, a little bit of a risk premium in the market. So we think the next big move could lead the oil price lower again, below 100 for WTI, maybe into the 90s again. But that will really depend in the short term also on how the political situation develops further. But we think it's a bit too expensive just from a fundamental point of view.
Tobias, it is actually quite rare that we get an analyst on saying that he believes the price of oil would go down. If we see this unrest continuing in countries like Saudi Arabia or other countries which are oil-rich nations, would that impact, of course, your forecast for oil?
Well, if we see how the oil price has developed when Libya tensions escalated, we shot up. Brent has reached $120 per barrel, and then the prices consolidated, came off slightly. Now that the focus is coming back on the Middle East, it creeps higher, but we still haven't seen new all-time high. So what that tells me is that the market is pricing in already quite a fair bit of tension. So we would really need to see a further level of escalation there to push prices higher. I think the risk premium in the market is already fairly sizable, and we would really have to see something new and more widespread than what we currently have. So
we were hearing from the Libyan oil minister saying that actually in terms of production now in Libya compared to January, they're possibly at 25%. If there is no more oil coming from Libya, do you still see that kind of price level because you're saying that it's already been priced in?
Yeah, I would argue for that. I mean, Libyan oil export, that was really hard to monitor over the last few days, where basically you had also conflicting news. So I think the market has already priced in almost a complete loss of Libyan production. So I think the focus is not so much on Libya anymore. For another push really higher, you would see something new.
Very interesting. What about volatility? Are you expecting that to continue?
I do, because at the moment we really see a little bit two opposing factors. The events in the Middle East that are pushing prices higher, and on the other side of the globe, the earthquake in Japan, which has basically given oil consumption a little bit of a dent, and the market focus is shifting between the two. So we have also price swings in the market. It's likely to continue for now.
Tobias, I wanted to get your view about, of course, the price of oil longer down the road. 3, 4, 5 years. How high can it go because of this production loss in Libya, which at the moment is quite minimal, but they have so much reserves in northern Africa?
Yeah, that's true. I mean, at the moment the situation is actually fairly comfortable if we look at inventories and spare capacities globally. But as consumption grows, we think it will be increasingly difficult to match this consumption growth with new reserves. So our forecast is that in the second half of the decade, basically spare capacities will reach lower levels, and that should justify a higher price tag and possibly new all-time highs.
All right, Tobias, great to speak to you. Tobias Merath there from Credit Suisse.